How are we doing, guys? This is Accounting with Ben, episode 2. We're going to be going over Goodwill in this episode. Goodwill, what it is, how to record it in a journal entry, and how to impair it when there's a certain loss. So, I got the definition from Wikipedia, and it states that goodwill is an intangible asset recognized when a firm is purchased as a going concern. A lot of words there, so let's break it down. So, intangible asset, what is that? Well, you know what an asset is. It's a physical thing. It really exists and it has values and provide value in the future, and you own it. Well, intangible assets pretty similar to that, but it's just an asset that lacks physical substance. So some examples like a patent, a copyright, a trademark. Like you look at the water bottle, it's a physical thing. I can hit it, it makes sound. But when you look at an intangible one like a patent or a trademark, it doesn't have like a physical form. It exists. We recognize that as existing. It has value. We know that, but it's not really like a physical, like a diamond or a computer. You know what I mean? Going concern is another concept in accounting, just meaning that we assume the business is going to be able to meet its financial obligations as they're due within the next 12 months. So, if a firm's going to go bankrupt tomorrow, it's not going to have going concern. Whatever. Let's keep going. And it's often understood to represent the firm's intrinsic ability to acquire and retain customer business that's not otherwise attributed to brand name recognition. It's only recognized through an acquisition, and it cannot be self-created. So it has to be gotten when you buy a business. It's not just you don't just get it randomly throughout the year. When you purchase a business in a certain situation, there's going to be goodwill. So let's go over that situation right now. I created this problem on Microsoft Word, and it states XYZ Corporation acquires 100% of the outstanding stock of ABC Company for $2 million. At the acquisition date, here's all the fair values and book values of their net assets are as follows. So first, we need to calculate the net asset value, which is the fair value of all the assets in the company minus the minus the liabilities, the total liabilities. So the total assets, $2 million right here. We have it listed out. We need the fair value of all the assets, $2 million, and then we have the value of all the liabilities of $800,000. We just do a simple calculation of $2 million minus $800,000. That leaves us with a net equals a net asset value, NAV for short, of $1.2 million. So then we need to look at what did we purchase the company for? Well, it says right here, we purchased it for $2 million. So for number one, we purchased it for $2 million in cash, but the total assets of the company that we purchased, or the net asset value of the company that we purchased, is 1.2 minus 1.2 million. That leaves us with a goodwill of $800,000. Now, how do we record this in our journal entries? Well, we got to debit some things. Debit increased the value. So we acquired some cash from the company. We'll debit the cash. We're also going to debit the accounts receivable. Remember, we acquired these accounts receivable, so they're going on our books now. We got some inventory. We got to debit that, and we got some PP&E. We got to add these to our books. So we're going to debit them to increase them. So that's $200,000 of cash, $300 in AR, $500 in inventory, and $1 million in PP&E. Now, we also have to go increase we also acquired some accounts payable and some notes payable. So we got to debit. We got to credit these. Sorry. So credit the AP, and also got to credit the notes payable. So that was $300,000 for accounts payable, and $500,000 for notes payable. Now we're missing some accounts. What are we missing? Remember, we purchased this company for $2 million. We need to record that. So we're also going to credit cash to reduce that by $2 million. Now, you may be thinking, the accounting equation, it has to balance. It can't be one side can't be bigger than the other. So on the left side, we have $2 million, and on the right side, we have $2.8 million. What's left over? The goodwill. We got to put the goodwill back in. So now we debit goodwill to increase it, $800,000, and that balances out both sides of 2.8. And now for the final part of the question. If later the fair value of ABC Company's assets decreases to $1.5 million, how does that affect goodwill? Well, remember this. When we bought ABC Company, it was $2 million. So now it's 1.5. So something happened in the company that reduced it. So the value has now been reduced by a serious amount. So now we have to look back at the company and say, we had to impair the goodwill. It's not the same goodwill that when we bought it. Remember, guys, the point of accounting, especially public accounting, is to portray an accurate picture of all the financials for investors, creditors, people that rely on these statements to utilize. And if the goodwill is wrong, then it's an incorrect statement. We gotta fix it. So the assets decreased by $500,000. So it started at $2 million. From here, there's $2 million up there, and now it went down to 1.5. So 2 million minus 1.5 million leaves us with $500,000 of decreasing. So the goodwill, in turn, is going to be reduced by that $500,000. So to book this, we have to debit a loss on impairment and credit goodwill to reduce it by the amount. You guessed it is 500 here, so 500,000 and goodwill 500,000. It's important to remember, guys. It's important to remember the point of accounting, guys. We're trying to just portray accurate statements, accurate data. Tax is another thing, but to know tax, I think you got to know accounting. You got to have solid fundamentals. So that's the point of the video. I'm working on my fundamentals. Hopefully, you guys are working on yours, and we're growing together. Thank you, guys. Leave some comments in the comment section below, and let's keep getting better.